Most people think money is created when governments print it. Others imagine banks are just moving piles of cash from one person to another. The reality is simpler and stranger. In modern economies, most money is created when someone borrows, and it disappears when that debt is repaid. To see how this works, forget coins and paper for a moment. Cash is money, but it is a small slice of the total. The majority of what we use daily is bank money, the numbers you see in checking accounts, savings accounts, and business accounts. That money is an accounting entry, and its life cycle is tied to credit. There are three players you need to understand: the central bank, commercial banks, and borrowers. Each has a role. None of them alone controls money the way people often assume. Start with the central bank. It sets the base conditions for the system: the policy interest rate, the rules for bank safety, and the supply of reserves. Reserves are a special form of money used by banks to settle payments with each other. You can't spend reserves at a grocery store. They sit inside the banking system. This is where a major misunderstanding begins. When a central bank creates reserves, it is not automatically creating spendable money for the public. Reserves help banks clear transactions and meet regulatory requirements, but reserves are not the same thing as your deposit balance. So where does your deposit balance come from? Most of the time, it comes from commercial bank lending. Here is the core mechanism. When a bank approves a loan, it does not typically take existing customer deposits and hand them to you. Instead, it creates a new deposit in your account. The bank simultaneously records an asset, your loan, which you owe back, and a liability, your deposit, which the bank owes you. Two entries are created at the same time. From your perspective, you suddenly have money to spend. From the bank's perspective, it has created a new claim and a new obligation. This is why people say banks create money, not because they print banknotes, but because a new deposit is new money for the economy. That deposit can be spent, transferred, and used to buy real things. It functions as money. Now, there is an important detail. The bank is not creating wealth out of thin air. It is creating purchasing power paired with a debt. The borrower's balance rises, but so does the borrower's obligation. Money creation and debt creation are two sides of the same event. This also explains why money can vanish. When the borrower repays the loan, the bank reduces the loan balance on its books, and the corresponding deposit is reduced as the money is used to repay. In aggregate, repayment destroys money. When loans default, money can also be destroyed through write-offs and balance sheet adjustments. The money supply is not a one-way expansion. It breathes. So, why can't banks just create infinite money by issuing infinite loans? Because they face constraints. The biggest constraints are capital, liquidity, risk, and demand. First, capital. Banks must hold a buffer of shareholder equity relative to the riskiness of their assets. Regulators require minimum capital ratios so that banks can absorb losses without collapsing. If a bank makes too many risky loans without sufficient capital, regulators can step in, markets can punish it, and the bank can fail. Second, liquidity and settlement. When you spend your new deposit, the money often moves to someone who uses a different bank. Your bank then has to settle that transfer with the other bank, typically using reserves. If a bank is constantly losing reserves because its customers are sending money out, it needs access to reserves through deposits, interbank borrowing, or the central bank. Third, risk. Banks want to be repaid. Creating deposits is easy. Surviving losses is not. Banks evaluate income, collateral, and credit history because their profit depends on the borrower's ability to pay interest and principal. Bad lending decisions can wipe out capital. Fourth, demand. Banks can only create money by lending to willing borrowers. If households and businesses don't want to borrow, the money creation machine slows down. This is why economies can feel tight after crises. People become cautious and credit growth stalls. This brings us back to the role of interest rates. The central bank influences the price of borrowing. Lower rates tend to encourage more borrowing and refinancing, which can expand bank lending and therefore expand money. Higher rates make borrowing more expensive, slowing credit growth and often reducing the pace of money creation. This doesn't mean central banks directly decide the money supply. It means they influence the environment in which banks and borrowers create it. What about printing money in the popular sense? In some situations, governments and central banks run policies that increase spending power in the economy, such as fiscal stimulus funded by borrowing or central bank purchases of financial assets. These actions can change financial conditions and encourage lending, but the day-to-day creation of most money still comes from commercial bank credit. There is also a deeper point that surprises people. Because money is created as debt, the system relies on ongoing credit expansion to remain stable when debts are large. Interest has to be paid, and while interest payments move money around, they don't automatically appear from nowhere. If the economy stops expanding credit while obligations remain high, the system can become fragile. That is one reason policymakers worry about sudden credit contractions. You can see the pattern in everyday life. In booms, lending standards loosen, confidence rises, and borrowing accelerates. Money grows quickly. In busts, lenders tighten, borrowers pull back, and repayment dominates. Money growth slows or reverses. The money supply is not just a policy dial, it is a reflection of trust and appetite for risk across millions of decisions. So, how is money actually created? Mostly through loans that create deposits. A bank approves credit, a new deposit appears, and spendable money enters the economy. Central banks shape the conditions, but commercial banks and borrowers drive the volume. And how does money disappear? When debts are repaid or written off, the deposits tied to those loans shrink. Money is not a pile, it is a process. Once you understand this, a lot of economic headlines become less mysterious. When people talk about tightening, they mean slowing credit creation. When they talk about liquidity, they mean the system's ability to settle and keep lending. And when they talk about financial stability, they mean keeping this money creation process from spiraling out of control. To make it concrete, imagine a simple mortgage. You signed for a $200,000 loan. The bank credits your account or the seller's account with $200,000. The seller now has a deposit they can spend. They might pay a contractor, who pays employees, who pay rent and groceries. One loan has created a chain of spendable balances that looks and feels like money in the economy. Yet the source was a balance sheet entry paired with a promise to repay. This is also why it helps to distinguish different layers of money. Physical cash and central bank reserves are often called base money. Bank deposits are broader money because they are created by private lending. Policies like quantitative easing mostly swap one financial asset for another inside the system, increasing reserves, lowering yields, and pushing conditions that may encourage lending. QE can influence money creation, but it does not automatically force new deposits into existence unless banks expand lending and borrowers take it. In short, money creation is not magic. It is accounting backed by enforceable contracts, constrained by regulation, and powered by confidence. Money, in the modern world, is less a thing you find and more a relationship you enter. It is created when someone takes on an obligation, and it lasts as long as that obligation remains alive.